the key thing that FedEx talked about is not only the, as you mentioned, the demand continuing, but going forward. So, after this huge spike up post-COVID, which we saw such a huge increase in e-commerce demand. But now, as we look forward, you're going to have the return as the vaccine gets distributed. You're going to have the return of B2B demand. As e-commerce begins to decelerate, it won't go negative, which was a key comment from the company yesterday, that it won't flip negative as everybody returns to work. Yet they believe that they're going to see obviously the B2B growth, the business growth return, which is a huge increase for profitable potential.
So FedEx was able to expand margins both on its ground business that handles the majority of residential e-commerce and on its express business. That was largely due to those holiday shipping surcharges they put on big retailers. As the economy begins to normalize and perhaps people don't buy as much online, can they continue to see that margin expansion?
Yeah, it's great. They've been so focused going back almost 2 years now on pricing, which was a weak point for the air freight carriers, FedEx and UPS, is that they seem to be competing against each other to get volume. Well, right now, what you've seen over the last few years has been volume has not been the issue, given the growth of e-commerce and the shift away from normal business activity. And given that demand, their networks were pulled forward about 3 years worth of demand. So you've got a full network. So now they are very focused on pricing. Obviously, in a peak crunch period, they were able to add on additional surcharges for COVID. Some of those have continued on some international lanes. Certain residential lanes have continued. But yet pricing came in on ground double what we were looking for, up over 11%. So really seeing that strength and focus that they've got on pricing after years of focusing on getting volume. And that's doing a great job for the margins, as you mentioned, which really led the quarter. And I think that was the upside surprise that you're going to see for the stock today, with ground margins up over 8.8%. That was well above target.
All right, before we let you go, Ken, you have a price target of $351 for FedEx. That's a 33% increase over the closing price yesterday. What do you see as being the catalyst? I think a lot of us think that the economy is going to reopen and a lot of people are going to go back to brick and mortar stores and perhaps not buy as much online.
Well, I think you might decelerate your purchasing, but I think what you've seen is the shift to e-commerce has really changed the way that we order. And I think that continues going forward. And then, as you mentioned, people are going to start going back to work. You're going to start seeing that B2B activity pick up. You've got this great strength. International activity was up 41% year over year. So obviously, without the belly space, you're going to see that continue maybe for another 18 to 24 months until the belly space on international lanes returns. But that gives you a good runway. And so we did actually decrease our multiple on our forward earnings, but that increased the price target because you've got such near-term strength on pricing and volumes that it looks really good for FedEx stock right now.
One last quick question, Ken. FedEx actually raised its CapEx guidance to increase its ground capacity. In your mind, was that a good move? Do you think the street's going to receive that well?
I think that's always been an issue for FedEx is investors really want to see the cash flow come through. What you're doing, though, is you're keeping CapEx to revenues below 7%, which is a record low for FedEx since we've been following over the past 2 decades. So you actually do have, because the top line is growing so fast, ground volumes were up over 20%. They've got to accommodate that with some more facilities on the ground side. They did accelerate some aircraft repurchasing or purchases and delayed some retirements. So that's the move to increase it a little bit to $5.7 billion this year on CapEx, but still generating increasing free cash flow, which is what investors are really focused on, given the very, very strong results.
Shepard Smith here. Thanks for watching CNBC on YouTube.